Over the last few weeks, this market has gone from deeply uncomfortable to looking almost unstoppable. The S&P 500 is back at record highs. The Nasdaq has ripped higher in one of its strongest stretches in years. And fear, well, that has flipped back to greed. If we just look at the performance of the market in the last week, strong nearly right across the board. We've got software that's starting to bounce. Tech continues to lead, and Wall Street, well, they're starting to act like the war scare is yesterday's problem. But this is exactly where today's episode gets interesting, because when a market moves this fast, there are usually two stories being told at the same time. The first is that the market is seeing something real: falling risk, resilient earnings, strong tech leadership, and a bull market simply reasserting itself. And the second is that rallies like this can ultimately be flattered by short covering, fast money, retail speculation, and CTA buying, and a huge repricing of hope before the underlying uncertainty is actually gone. So in today's macro section, I want to break down what is real, what looks technical, what the market may be getting right, and what it may be getting wildly ahead of itself on. First, let's just appreciate how unusual this move has been. This has not been some slow, grinding recovery. This has been a violent reversal. The S&P 500 has just logged a double-digit gain over an extremely short stretch. The Nasdaq, well, that's put together one of its longest winning streaks in decades. The VIX, that has collapsed, and momentum has gone from washed out to overheated in almost no time. And it matters because it immediately tells you this is not just a calm fundamental repricing. This is a market that has moved from fear to confidence at breakneck speed. You can see this in the RSI data too, one of the fastest moves from oversold to overbought ever recorded, and historically that has often come with strong medium-term returns, but it also tells you the rally is becoming very crowded very quickly. And maybe the cleanest emotional summary of all of this is the Fear and Greed Index. Just a month ago, the market was dealing with extreme fear. Now we are back in greed territory. So before we even debate whether this move is right or wrong, we should start with the obvious point that this has been an aggressive shift in market psychology, and that shift in psychology is exactly why even some bulls are admitting this move feels almost too easy.
This market, look, it's not a market any of us have ever seen. It makes no sense. It's too easy. When markets are too easy, that's when trouble starts brewing, and you can't believe the headlines. You can't believe anything coming out of headlines because there's one narrative coming from Washington. There's another narrative coming from Iran. You can't believe either one of them. So basically what you've got to do is stick to fundamentals. And if you're a long-term investor, stick to that, block out the noise.
And that is probably the best way to frame this entire section. The rally is real, the strength is real, but the speed of the move is also telling you positioning and emotion are doing a lot of the work here. Now, to be fair to the bulls, they do have a case. If you're trying to explain why this market has been willing to rip higher, the first answer is simple. Investors are increasingly deciding that the worst case geopolitical tail risk has ultimately faded. That doesn't mean the situation is fully resolved. It clearly is not, but markets do not wait for perfect clarity. They move when the probability of catastrophe starts to fall, and once that tail risk begins to ease, investors quickly turn back to the things that were already working before the panic: resilient earnings, strong big cap balance sheets, and the fact that tech still remains the market's primary engine. Historically, some of the signals that we are seeing now have also been constructive. New highs in April have often preceded further strength later in the year. Multi-week surges of this kind, while uncomfortable in the moment, have not always been bearish signals. Sometimes they're exactly what bull markets look like after a fast correction. So the bull case is not stupid, it is not even especially complicated. It basically is this: the market got scared, priced in too much risk, and is now snapping back towards a more optimistic baseline. And Tom Lee made that exact case earlier this week, and he didn't just say the market is fine, he said it may actually be in a better position now than it was before.
I think the stock market is in a better position today than earlier this year when it made its all-time high. Because one, we're now seeing that the U.S. stock market can handle a surge in oil while it hurts other countries. We've seen earnings go up, so we now feel comfortable that the war is actually stimulating the economy. And the third is I know I've talked before about inflation shocks, but we've been looking back at the history of oil spikes, and the impact on core is less than we thought. So I think there may be less of an inflation shock coming.
That is the clean bullish argument in one soundbite. If the market has already stress tested an oil shock and earnings are still holding up, then maybe the rebound is not irrational at all. And it's not just Tom Lee. Across Wall Street, you can hear a very similar message. This may have been a correction inside a bull market, not the start of something worse.
This does not necessarily mean that we're out of the woods. At the same time, we believe that it's an incredible buying opportunity. In our view, this is a bull market, and this is a correction within the bull market. So investors don't necessarily need to wait for all clear to bring some risk back into their portfolio.
So the bulls are not just saying buy because line goes up. They're saying this was a fear-driven correction, and the markets may already be moving back towards the broader bull trend. But here is where I think the market gets much more debatable, because there is a huge difference between tail risk falling and uncertainty actually disappearing. And right now, the market, it seems to be acting as if the path from here is straightforward. Ceasefire progress, Hormuz essentially normalizes, oil falls, inflation risk phase, and the whole thing becomes essentially a temporary scare. Now that may happen, but there is also in fact a much cleaner outcome than the actual reporting suggests. Some headlines imply reopening, others suggest a full deal could still take months. Some statements, they sound definitive, others sound conditional, and even if the military or diplomatic risk has fallen, it does not automatically mean commercial flows normalize instantly, tanker routes reset overnight, or companies behave as if the all clear has been given. This is the difference between the market trading headlines and the real economy adjusting to them. Now this next clip is important because it captures the exact disconnect the market may be missing. A ceasefire headline is not the same thing as a full normalization.
This move feels optimistic, especially as the market reprices the idea of reopening faster than it actually can reopen and the flows will resume. And President Trump also said on Truth Social just now that the blockade will continue, which again does not suggest a normalization of flows. Now, both WTI and Brent are below $90 and less than $20 above where they were prior to the war breaking out.
That is the key distinction. The market is pricing the idea of reopening. The real world still has to prove it. And even among investors who are constructive, there's a clear acknowledgement that the market may be moving past the uncertainty faster than the uncertainty is actually disappearing.
Investors seem to undermine the risks of the market and seem to just really move over the uncertainty. And that's what we're seeing with the Strait of Hormuz situation, that we take the news every day as it comes. And of course, today, the indication that the activity in the Strait would reopen is fantastic. We see this in appreciation of the stock prices and the decline of the oil prices.
So this is probably the cleanest skeptical line in the whole debate. The market may not be wrong directionally. It may just be too early on the timing. Now this is where the rally gets even more interesting, because if you look under the hood, there is plenty of evidence that this move has not just been about improving fundamentals, it's also been helped by mechanical forces. Short covering has been a big part of this. Some of the most heavily shorted names have ripped higher. Retail traders, well, they're in fact back, and risky corners of the market have started to come alive again. CTA-style trend-following flows have also accelerated into the move. Look, none of that invalidates the rally, but it does matter because rallies driven by short covering and fast positioning can go much further than people expect and still leave behind an exaggerated picture of underlying conviction. In other words, the move can be real and still be flattered by mechanics. That's why these heat maps are so useful. If we look at just the last week, it looks incredibly powerful, lots of green right across the board. But when you zoom out to drawdowns from 52-week highs as well as the year-to-date performance, you can still see some of the market's biggest winners are simply the names that are coming off very sharp prior dislocations. And Bloomberg put it very directly this week: if you want one simple explanation for the violence of this rally, look at the bears that are getting carried out.
Talk a little bit about
what
has happened to the bears over the last few days. Bears have covered $93 billion. Yeah. Not the
where
sports.
Are those bears?
I'm not a big sports guy.
Yeah.
But I don't think it's football season. $93 billion worth of short positions across U.S. stocks so far this month. The Russell 3000 and the S&P jumping more than 9% over that time. Short covering, adding momentum to the rally. How much of the momentum, Katie, has been short covering? That's the question.
And once you understand that, the rally starts to make a lot more sense. Not necessarily less bullish, but definitely more mechanical. And there's also another layer to this too. Trend following money has also been forced back in very quickly. The CTA positioning chart is a great example. Over just the last few sessions, a huge amount of global equity exposure has been added back in. Again, it doesn't tell you that the rally is fake, it tells you that the rally is being accelerated. And if there's one section that really decides whether this rally has legs, it is gonna be tech. Because tech is not just participating, tech is ultimately leading again. The Nasdaq has been the standout since the bottom. Software, well, it staged one of its strongest rebounds in decades, and investors are piling back into the exact area of the market that matters most for index leadership. And here the bulls also have more than one argument. Firstly, valuations. Well, they're ultimately compressed. The easy tech is too expensive argument is not as simple as it was a few months ago. On several forward P measures, tech is now back below longer run averages, and software premiums versus the rest of the market has fallen sharply. Second, we have insider behavior, which has improved. Tech insider buying hitting a 15-year high is not the kind of thing that you ignore. And third, market leadership often returns to where the earnings power is strongest, and whether people will like it or not, it still means large cap tech. Now, that does not mean every tech stock deserves to work, but it does mean the market is making a very specific bet here that the correction reset the group and that the leadership trade is back. And Josh Brown made a really important point this week. Yes, software has bounced, but that doesn't automatically mean the most beaten up names are where the best leadership will come from.
I think this is really interesting. The market bottom, Scott, on March 30th, okay? Even despite the big comeback that we've seen, the SMH, the semiconductors, are still outperforming the IGV since that March 30th bottom, and I don't think most people think that's the case. A lot of people think, oh, we've had this huge comeback in the software trade. It's not true. Right. So the primary trend is still Halo Tech. The SMH is up 22%, and it's unbelievable, since that March 30th low. That's like 2 weeks ago. The IGV is up 2, but it's only up 9%.
I understand, but the IGV, by the way, just to throw it out there, is up 13% this week.
But I'm making the point that it's still being outperformed by double by the non-disruptible AI trade. And even though the IGV was in a 34% drawdown on March 30th, which is also incredible, the SMH was only in a 14% drawdown, and semi still went up. So the point is, this is not the signal to now take your portfolio and say, let me buy all the stuff that got killed. The winners are still winning.
That's an excellent nuance. This is not just tech is back, it is a much more selective leadership fight inside tech itself. And Dan Ives pushed the bullish side of that debate even harder after coming back from Asia.
I mean, we're not seeing any cracks from an AI build-out perspective, which means from an earnings perspective, that's not just bullish for hardware players, the hyperscalers, the Microsofts, the Googles, the Amazons, and ultimately you talk about the software trade, that's where the ripple effect's going to be. So I just think this is a bright green light going into earnings season, everything we see from a demand perspective, and I think that's the key right now. It comes down to monetization. We come way incrementally more bullish.
So that is the bullish tech thesis in one sentence. Demand still looks strong, valuations have reset, and earnings may be about to validate the move. But this is where I think the story gets much more nuanced and much more interesting, because tech can absolutely lead while parts of the AI narrative are still far messier than the market wants to believe. There is a big difference between AI excitement, AI spending, and AI demand that is durable, profitable, and properly priced. Right now, well, a lot of the market, in fact, is still assuming those things are basically the same. They are not, because if companies are burning through budgets faster than expected, if token usage is being gamed, if inference costs are far higher than expected, or if flat rate plans were disguising uneconomic demand, then the build out may still be real, but parts of the monetization story becomes much more fragile. Now, that does not automatically mean the AI trade is broken. It means software pricing power and return on investment may matter a lot more from here than the simple usage headline. and this next clip is one of the most important in the entire video because it attacks the AI demand narrative at the exact point investors have become most comfortable.
That's the CEO of Anthropic on the Dwarkesh podcast, talking about the biggest spending cycle in tech history. His company, it's the only major AI lab pricing for what demand actually looks like. So what's happening? Every time you use AI, it costs tokens. They're the basic unit of AI consumption. Every question that you ask, every answer it gives back, every line of code it writes. A simple chat, it costs a few hundred. But the new generation of AI agents, the ones that can browse the web, write code, complete tasks on their own, they can run for hours in the background, burning through millions of tokens without you even watching. It's the difference between ordering a car and sending that car out to run errands all day on your credit card. And right now, no one knows how to budget for it.
This is a very serious point. AI demand can look explosive and still be economically messy underneath. And the deeper concern is this: if parts of the current demand are temporary, gamed, or uneconomic, then some of the infrastructure assumptions behind this whole cycle may still be too optimistic.
Demand is what the entire AI investment cycle is built on. It's how NVIDIA justifies selling hundreds of billions of dollars in chips. It's how data center companies justify building 30 gigawatts of capacity. It's how the biggest names in tech justify pouring billions of dollars into infrastructure. The assumption is that all this usage keeps growing. But if a meaningful chunk of it is employees gaming leaderboards, agents running in loops, or companies just blowing through budgets they can't sustain, then the infrastructure being built to serve that demand, well, it may be sized for a number that isn't real.
That does not kill the AI bull case, but it absolutely raises the bar for software and monetization to prove themselves during earnings. So where does all of that leave us? And I think the answer is this: the market has probably been right to move higher, but it may also be moving higher for reasons that are not all equally durable. Some parts of the rally look real, tail risk has fallen, earnings have held up better than feared, tech leadership, well, that is back, valuations, well, they're becoming less stretched, but other parts of the rally clearly look technical. Short covering has mattered, CTA buying has mattered, retail behavior has picked up, and the market has moved from fear to greed with incredible speed. And from here, next move probably does not come down to whether the market feels strong, it comes down to whether the pillars underneath this rally actually hold. Number one, do earnings and guidance confirm what prices are already implying? Number two, does the rate backdrop actually get easier, or has the market moved too early on that hope? And number three, does the geopolitical story keep improving in the real world and not just on social posts and headlines? And finally, can tech and especially software prove that the rebound is about earnings and monetization and not just a positioning reset? Because if these things hold, then the bulls may look very smart for leaning into this aggressively, but if earnings disappoint, if rates stay sticky, if geopolitics drag on, or if tech monetization cracks under scrutiny, then this rally may start to look exactly how it feels right now: powerful, impressive, and maybe just a little bit too easy. And the rate piece is probably the most underappreciated risk in this whole rally.
Certainly, interest rates should not be lowered. I mean,
should not be lowered?
Not be lowered. But I mean, interest rates right now, real interest rates are less than 1%. You would have a hard time convincing me that the real so-called equilibrium interest rate is less than 1%. We're starting, it appears to me, to be in an inflationary boom. We have very favorable tax environment right now with the tax breaks that were introduced in January of this year. We have very strong spending in the government. We have a war going on that's going to add to demand. We have new investments that are $500 billion for AI. We have very strong corporate earnings that's going to support other investment.
And that is why rates matter so much here. If the market is assuming relief that does not come, part of this recovery story gets a lot harder to sustain. So that is the macro backdrop right now, a market that has recovered with incredible force, a rally with real reasons behind it, but also one being helped by technicals, positioning, and a market that may already be looking past risks that are not fully gone. And with that in mind, let's move into some stocks, because if this rally is going to keep going, then leadership is going to matter a lot. Now, before we wrap up, I want to end on two names that actually tell you a lot about the type of market we're in right now. The first one is Netflix, because Netflix is one of the clearest examples of a stock reporting what looks like a pretty solid quarter on the surface, and still getting hit hard anyway. The stock closed down almost 10% on the day, and that immediately tells you something important. The market is not just rewarding companies for being good, it is rewarding companies for clearing a very specific bar that investors have already built into the stock. Now, the quarter itself was not a disaster. They reported revenue of around $12.3 billion, which was up 16% year on year. Earnings per share 123, so this was not some kind of collapse in the underlying business. Revenue was up nicely, earnings were strong, and profitability remains very impressive. But the market clearly wasn't focused on the backwards looking beat, it was focused on what comes next, and this clip really explains that well.
It's definitely the lighter guidance. So I think not only were we looking at the second quarter guidance, which of course is lighter both on the revenue side as well as on the EPS front, but we were also anticipating some kind of a take up for the full year revenue guidance. So remember, the quarter before they had said 12 to 14% for the full year, and they basically just came out this time and reaffirmed that same number. And I think the street was really looking for all the recently implemented price hikes to contribute to maybe at least 100 basis points of improvement in revenue growth. The same goes for operating margin.
And that right there is the key point. Netflix didn't really fail on the quarter. It failed to give the market enough new upside relative to what was already being hoped for. And this matters even more when you look at how Netflix had been trading going into the report. The stock had already rallied sharply after the Warner overhang had cleared. Investors were relieved Netflix didn't end up doing some massive deal that would have loaded the company up with complexity, debt, and integration risk. So part of the stock's recovery had essentially already happened before earnings even landed, which means by the time this quarter arrived, investors were no longer just asking, is Netflix okay? They were asking, now that the M&A overhang is gone, how strong is the core business really? And the answer from the stock was basically strong, but maybe not strong enough to justify even high expectations right now. Where on top of that, you also had the Reed Hastings board departure headline in the mix. I don't think personally that is the main reason the stock sold off, but it does remove one more familiar anchor point from the Netflix story. At the same time, the market is already trying to reassess what the next phase looks like. And there was another part of the story too. Some of the pressure here looks less like demand falling apart and more like timing, spending, and how these costs are flowing through.
On the EPS front, and the reason why we're seeing a little bit of pressure in terms of guidance for EPS and operating profit is because they do expect very, very heavy content amortization in the second quarter. So, they think that would ease a little bit in the second half, but in the second quarter, it's going to be pretty heavy, which might be part of the reason why they're still kind of taking a little bit of a conservative stance. And, we've seen them kind of really invest in a lot of different pieces of content, most notably sports, whether, it was the MLB opening day game or the World Baseball Classic, and you have a couple of boxing matches coming up.
So again, that's a very different story from saying Netflix is broken. What it really says is that the market may be reacting to a softer near-term setup, not necessarily a weaker long-term business. And this is where I think the chart work becomes really useful, because when you actually step back from the stock reaction and look at the underlying business, Netflix still looks extremely strong. Growth, that remains solid. Profitability, that is elite. And with free cash flow, we can see it continues to improve dramatically. Revenue, that continues to climb right across every single geography. And the balance sheet for Netflix, well, it's become much, much cleaner over time. This is not the profile of a business in trouble. In fact, if anything, it looks more like a business that has matured into a very high quality cash generating platform, one that the market simply expects a lot from now, and that is the difference. Once a company reaches this stage, good is often not enough. You don't just need growth, you need enough growth, enough confidence, and enough guidance to keep a very demanding shareholder base excited. And what makes it even more interesting is that depending on the framework you use, Netflix no longer looks obviously absurd on valuation the way it once did. On a forward P basis, it trades 27 times forward earnings. That is above the sector, so you're paying an 87% premium. But if you compare that to their 5-year average of 37, it's offering investors a 28% discount. Price to earnings growth 1.3, not too dissimilar from the sector overall, and you're getting a slight 8 to 9% discount from their own 5-year average. And then if you take a look at our updated valuation based on this most recent earnings, we've increased our price intrinsic value, now sitting at $118, derived solely from the DCF model. We just want to flag a few changes. We updated their balance sheet data, as well as they've increased their guidance for the future free cash flow for 2026 to 12.5. Previously, it was sitting at 11. So now on a reverse basis, they're essentially telling you the market is expecting 11.8% over the long term. Their 6-year CAGR sits at 36%. This disconnect right now, using what we would consider a fairly reasonable 15% growth rate, is offering investors a 22% margin of safety, which also reflects here an 18% margin of safety. In terms of Wall Street, for Netflix, they see 115 over the next year on average, indicating 19% upside. So the argument here is not that Netflix is cheap in every possible way, it's that Netflix now sits in that uncomfortable middle ground where the business is excellent, the stock may still have upside, but the bar is high enough that any guidance wobble gets punished fast. And if you want the strongest, concise, bullish rebuttal to the sell-off, it's probably this.
It's 10% down in the stock this morning. Like often with Netflix earnings, I don't think the stock market reaction has it right. I think the Netflix story is very much intact. Strong double-digit growth in revenues, doubling cash flow, on track to double ad revenues, operating margins over 30%, and on track for good operating margin growth for the year. And it's clearly, with its profit, with its programming budget, with its low churn, with its ability to raise prices, in a totally different realm than any of the other long-form entertainment streamers.
And that's why I think Netflix is such a useful case study, because you can simultaneously believe the business is extremely strong and still understand why the stock sold off. But there is one part of the bear case that I do think matters, and it's not really the quarterly beat or miss, it's attention, because when you look at the share of US TV time, Netflix is still huge, but YouTube is even bigger. And that matters because the next battle in media is not just who has the biggest content budget, it's who wins the most hours, the most engagement, and the most habit. And this is the part of the Netflix story that I would not ignore.
The question is viewership per sub. And I think with YouTube competition, with competition from free advertiser-supported streaming channels, they're clearly growing much faster in viewership than Netflix is. And that's an issue for the long term.
So the short version on Netflix is this: great business, strong quarter, softer guide, high expectations, and a very real long-term battle for attention still sitting underneath the surface. And then right after that, you've got a very different kind of story in Figma, because Netflix is about expectations, Figma is about disruption, and Figma fell around 7% after Anthropic launched Claude Design. And this is one of the cleanest reminders that AI is not just creating winners, it is also pressuring incumbents in real time, because once the market sees a tool that can start generating mock-ups, prototypes, one-pages, or visual workflows from prompts, the immediate question becomes how much of Figma's workflow moat is actually durable, not because the company disappears tomorrow, but because investors start wondering whether some of the lower end or faster turnaround use cases become easier to attack than most people thought. And to understand why the market reacted like that, you really need to see what Claude Design is actually trying to do. And that is exactly why the stock moved, because once investors see that kind of workflow start to emerge, they immediately begin repricing anything that sits too close to it. Now, to be fair, Figma is not some dead business here. Revenue growth is still strong, the company is still scaling. Just in the last year, their top line was up 41%. Compare that to the sector that sits much lower at 10%, with analysts believing that it's going to grow earnings per share above the sector at 16% at 20% annually, at least over the next 3 to 5 years. And then based on our own valuation work, we get an intrinsic price of $32 against the market price of around $19. This would imply very significant upside if the business keeps compounding and the market is overreacting to competitive fears. You can see the margin of safety sits at 40%. Even Wall Street, they're very bullish. They see $40 over the next year, more than a double at 112%. So we would say with Figma, this is not a simple story of Claude launches a feature, therefore Figma is finished. It is a story of the market rapidly repricing uncertainty, and in a market like this, that can happen brutally fast. In other words, Netflix got sold because expectations were high, Figma got sold because uncertainty just got higher. And I think that's actually the perfect way to end today's episode, because this market is doing two things at once. It's pushing indices back to highs, rewarding strength, rewarding resilience, but at the exact time is still aggressively sorting through which businesses deserve premium multiples, which ones are vulnerable to disruption, soft guidance, or changing expectations. And also bear in mind, earnings season has just begun. We have another packed upcoming week, so let me know if you want me to cover any of these in more detail before or after earnings. But remember, Netflix shows us here that a great business can still get sold if the bar is high enough. Figma shows you that the market is still moving very fast against anything that looks even slightly exposed to AI workflow compression. So yes, this is a strong market, but it is not a lazy market, and that is why we always say stock selection matters. Now, if you enjoyed today's episode, don't forget to smash that like button, hit that subscribe and bell button too. Also, click on the pinned comment below where you'll be able to sign up to our free weekly newsletter. We draw on every single Monday morning, covering severely undervalued stocks, as well as what's gone in the market in the last few days, where you'll also be able to grab our April 26 capital allocation sheet, stocks that we own, the quality of these, our own conviction, as well as our individual allocation ranking. And as always, have a great day. We'll see you all on the next one.